My name is Caitlin Moore, and I'm the Financial Literacy Manager here at Union Bank and Trust. And today I want to talk post-crisis financial wellness. This is specific to our pandemic that we're currently going through. And as things are winding down and aid is going to start dropping off, I want to talk about how do we stay financially well even after our transition back into full-time employment or even part-time employment. So to start off with, I want to explain the CARES Act and what it has been helping folks with. The CARES Act is the Coronavirus Aid, Relief, and Economic Security Act. There was a lot of money put into this that was given to the country, people, businesses. But one of the things it allowed was for folks that are receiving unemployment to get an extra $600 a week from the federal side of things. So unemployment comes from the state, and then the CARES Act initiated a $600 a week add-on to that unemployment. So currently, an unemployed person could be receiving up to 50% of their pay from the state through unemployment, plus $600 each week extra. For a lot of people, this actually is earning them more than they would be paid if they were working full-time. So this extra $600 a week or $2,400 a month plus the 50% of the regular pay may be more money than if you were to go back to work and work full time. And I want to ask ourselves this question: how do you go from receiving more than enough back to not enough? How do you proactively prepare for another crisis? There's a lot of news that there might be another surge later on for the pandemic, especially in the fall and winter months. We have no idea. We do not know how this is going to turn out. We can only work with what we've got. And I want to talk financial wellness and how we can prepare for possibly another crisis, whether it be COVID or something else along the lines. How do we actively prepare for another crisis? So transitioning from more than enough. One thing I want to suggest right now, and I'm trying to do this before July 31st, when this comes to an end, save what you can. If you're receiving the extra $600 a week, but you are not using all of it or don't necessarily need all of it right now, if you can put some of it away, that's going to help you later, especially if another crisis were to hit or a personal crisis were to hit. Put away extra funds while you're still receiving them. So right now we have another month of the CARES Act stimulation, $600. Saving for a rainy day makes proactive planning easier. So if we're able to save money now, it makes it easier for later on when we need the money. Let's talk savings. Emergency savings. So as you're planning to go back to work, whether part-time, full-time, maybe it's another side hustle, whatever that looks like, what does it look like to have adequate savings? So what is it? Savings is typically your first step in savings is to save enough to cover copays or deductibles or small emergencies. So typically an emergency savings is around $500 to $1,000. Now this may seem like a lot, but I want to talk about what it would be used for. So if we had a flat tire today or a car accident, or you needed to go to the doctor, what would it take to get you there, to get you that tire, to get you out of a bind with your car accident? And oftentimes we look at deductibles or copays. So for car insurance, if you have a higher car insurance deductible, say $1,000, it lowers your monthly premium. So in order to have a lower monthly payment, you might hike up that deductible to $1,000, but that needs to be your emergency savings, $1,000. So if you were to get in a car accident today and your car insurance says, well, we'll pay for the damage, but you have to pay the $1,000, you would have that available at this point. Or if you walked out of your house and you had a flat tire, you needed a couple $100s to replace your tires or a couple of them, you would have that money to do so. So building up an emergency savings is really key for these unexpected, unplanned situations that we all really do find ourselves in at one point or another. So think deductibles. A lot of folks go for the $1,000 deductible on things just so that their premiums are lower, which is great. So save a little bit at a time and get that $1,000 in cash or in a different savings account. So saving $1,000 may seem like a lot of money. Every penny counts. Even if you're your goal is $300 just to cover a flat tire, that would be great. Just save the $300 and keep working up. Ask yourself, am I going to get a bonus? Could you pick up a side job, sell things online, things like that? But if you're receiving that extra $600 and you may a week and may not need it all, this is a great time to put some of it away just to save for the rainy day or the emergency fund. When you've reached your goal, so when you've saved $1,000 or whatever you deem as your emergency savings, what do you do now? One is don't spend it and do not account for it in your budget. So if you're budgeting, do not account for this $1,000. It is there if you need it, but it's there for emergencies. It's not there to go out to eat with or buy coffee with. It's there for the emergencies. Keep it somewhere safe but accessible. Some people open up extra savings accounts or they keep it in cash somewhere in their house, but it needs to be accessible. So you don't want to tie it up in investments or a CD or something like that. It's there when you need it in an emergency situation. If you use the money, so say you did have a flat tire, you had to pay your car deductible to get it fixed because of an accident. If you use it, just save it up again. Start plugging away at that to get the extra $1,000 savings. So your $1,000 or your emergency fund should be around at all time in the event that there is a crisis or an emergency. Long-term emergency funds, this is after you saved your $1,000. This is really long-term savings after you're out of debt. It's suggested by experts to save 3 to 6 months of expenses. So right now during this pandemic, it's been about 3 or 4 months of a lot of folks not being able to work, but they have expenses. And there's been a lot of resources available, including all those wrapped up in the CARES Act, but it's slowly going away. So these 3 to 6 months of expenses would be taking into account for your bills, what you have to pay every month, and then saving up 3 to 6 months worth of that. It's not your entire paycheck, it's just what you would be spending in a time such as these, in a pandemic, if you're not working. What do you need to survive? And then once you save that, don't spend it. Keep it somewhere accessible, but safe, so maybe another savings account. But it's there if you need it in a time of crisis. And once you've used it or if you've used a portion of it, save it up again. You're ready to go for the next crisis. One of the other things we want to do in being proactive is really considering what needs to be in our budget and what does not need to be in our budget. And I call it the needs and wants. So if you're making your budget, which I would highly suggest you do, even right now before the CARES Act comes to an end, as far as that $600 a week, figure out your budget, but decide, does everything in here need to be here or do I want it to be in here? So it's very important. So I'm going to give you some examples of needs. Needs would be food, shelter, utilities, transportation, essential clothing, a phone, you need insurance, gas, you need to be paying on your debt, continually paying on that, and then car maintenance. Those are the things that we really need. We can't live without them. We need to be saving for them or using our funds to be paying on them. Wants, however, are eating out, entertainment, new pets. Yes, we may have pets, but new pets would be a want. Hulu, Netflix, cable, vacations, gifts, new phone. Those are wants. Those are upgrades from maybe what your needs list is, but they're wants, and they do not have to be in your budget. So once you make a budget, it's very important to go over your budget to decide, do I really need this in here, or am I just putting it in here because it's a want? Because that's going to translate into how much you need to make every month or how much your 3 to 6 months of savings actually needs to be. A lot of people ask when assessing their needs versus want is, can I still get my wants? Sure, your wants aren't prohibited. It's just saying that it should be your second choice. So when you're considering some of your wants, like eating out, so food is essential, but eating out is not. We can cook, we go to the grocery store and cook at home, but we don't have to eat out. But if that is a want of yours, you need to assess, do I have the money in my budget for this? Could I get it cheaper somewhere else? If I wait, will it become less expensive? And most importantly, can I live without it? So the basis of a want is that you can live without it. You don't need it to survive. So you're going to want to ask yourself those questions as you're applying things to your budget, especially if it is on a want list. Doesn't mean you can't have it, but maybe ask yourself, do I really need it? Paying down debt. This is really important in a time like now, especially if you are bringing home more than enough, even if you're on unemployment. Unemployment right now, like I said, a lot of folks are earning more than they originally did when they were working full time. So what do you do with this right now in preparation of not receiving those funds anymore? Well, one of them would be pay down debt. Um, Debt, we want to figure out how much we have in debt, where all the debt is going, and we want to list those debts from smallest to largest. If you want to get out a piece of paper and list what type of debt it is, and then categorize them from smallest to largest debt. Make minimum payments on all those debts at all times. You always want to keep yourself out of collections or more fees or more debt. So make minimum payments, but use any extra funds you may have, including that $600 a week if that's more than enough for you. Use those funds to pay down each debt. And you're going to start by paying off your smallest debt first. So you're going to pay all of your minimums, and you're going to put extra funds on that smallest debt until it's gone. And then you apply all of the funds you were putting on that smallest debt and apply it to the second one on the list. So actually your budget towards debt never changes, it just moves. So minimum payments on everything, apply anything extra to one debt until it's paid off, and then apply all of that money that you were paying on the next debt. We call it the debt snowball. So you're just adding to the debts, but you're never really changing your budget on how much you're putting towards your debt. So in conclusion, I would encourage you to save what you can, when you can, as soon as you can, especially right now, knowing that the CARES Act stimulus is going to end on July 31st. If you are receiving unemployment, you would still be eligible for that from the state standpoint. So that's at up to 50% of your income, but you will not be receiving the extra $600 a week. So if that is more than enough for you right now, I can't stress enough how important it would be to save what you can, do some proactive budgeting, pay off some debts if it allows you to, get that out of the way, because it's very important to understand what's in your budget and what it's going to look like after the CARES Act ends and after those extra funds are hitting your wallet. And then plan ahead. Plan ahead by saving up for your deductible, so that if you got in an accident on August 1st after the stimulus ends, that you have enough money to pay for your deductibles or any medical needs you may have, things like that. So save what you can, when you can, as soon as you can. And if you have extra questions about this topic, as it is urgent, and maybe you want to be a little more proactive about your budgeting, that's going to change drastically as of August 1st, feel free to reach out to me. That's what I do. I can coach you through some financial situations, help you with some resources. If you're needing more help, especially after July 31st, I can point you to some community resources. So I want to help. So please reach out to me. My email, caitlin.moore@ubt.com, or my office line is 402-323-1467. But until then, thank you so much for your time and hope to hear from you soon. Thanks so much.